Welcome to today's video, where we will uncover the key facts about capital gains tax on home sales. Understanding the exclusions and qualifications is crucial for any homeowner looking to sell their property. In this video, we'll start with an introduction to capital gains tax on home sales, followed by the criteria for exclusion. We will then explore the ownership and use tests, special considerations if you've used the home as an investment, and why consulting the IRS or a tax professional is important. Finally, we'll summarize everything with a quiz. Before diving into specifics, it's essential to grasp what capital gains tax is. When you sell an asset for more money than you paid, that profit is considered a capital gain. And in many cases, you might have to pay a tax on that profit. You may be able to exclude up to $250,000 of capital gains if filing singly, and up to $500,000 if married and filing jointly, provided you meet certain criteria. Central among these is the ownership and use test. The home must have been your principal residence for at least 2 years out of the last 5, and you must have owned it for the same period. These durations do not need to be consecutive. The ownership and use tests are crucial. You need to own the home for at least 2 of the last 5 years, and live in it as your primary residence for at least 2 years as well. The unique part is that the residency does not have to be consecutive, but it must be within the 5-year window leading up to the sale. Now let's talk about some special considerations. If you own multiple homes, the exclusion will only apply to the home you primarily reside in. Furthermore, if the home was used as an investment, such as being rented out, this might modify how much you can exclude from taxes. Let's test your knowledge with a pop quiz. What is the maximum exclusion amount for a married couple when selling their primary residence? Here are your options. A. $250,000 billion. $500,000 C. $750,000 D. $1 million. You may pause the video now to think about the answer. We will discuss the correct answer in the next section. The correct answer is $500,000. Married couples who file jointly can exclude up to this amount from their capital gains on the sale of their primary residence. To wrap up, we covered the essentials of capital gains tax on home sales, the criteria for exclusion through ownership and use tests, and special considerations such as investment properties. Don't forget to consult the IRS guidelines or a tax professional for a clearer understanding. Thank you for watching. Please like, share, and subscribe to our channel if you found this video helpful. Let us know in the comments what you think or if you have any questions.